Hey everyone, we're going to take a quick break to talk about our sponsor for the month, the Von Mack Agency. Von Mack is a full-service digital marketing agency with a focus on tour and activity operators. They offer it all. SEO, websites, pay-per-clicks, logos, content writing. If it's online marketing, they got you covered. As we mentioned before, it's uber important to hire an agency that understands our industry. And the Von Mack Agency knows water sports. Trust me.
And they do all the shit that you don't want to do. They do all the shit that you're probably not very good at, and they are. Look, for listeners of the show, America herself is giving a free consult, all right? If nothing else, give her a shout, give her a call, take 30 minutes out of your day. More importantly, take 30 minutes out of her day so she can get you straight on your marketing needs.
That's right. What do you have to lose? Head to vonmackagency.com and go to the Contact Us page to get started. Again, vonmackagency.com. And most importantly, let them know you were sent by the AWG guys. All right, let's get back to the show. Hey everyone, and welcome back for another episode of the Awkward Watersport Guys podcast. On today's show, we have a returning guest, Chris Batchelor, CEO of Red Hospitality, and we're going to talk more about startups, sweat equity, and some of the things that you're probably thinking about on a daily basis, and we're going to bring to light and have Chris help walk us through those things. So without further ado, Chris, how you doing, man?
Doing well, guys. Thanks for having me. Happy to be back on the show.
Yeah, man.
Yeah, and I just want to say thank you again, you and Red, for sponsoring the Watersport Forum. Gave an amazing presentation with Rachel, and it went over really well. Got a lot of compliments as we were talking pre-show about how everyone tried to run you down to talk to you afterwards. And I just think it's great how you just open yourself up to talking to small and large businesses and helping them with a lot of their questions. So that was really great to see.
Yeah, no, happy to do it. And for any of your listeners out there and the larger industry, whatever I could do or our team can do to help those questions, whether it's, getting engaged in the Facebook groups or otherwise. If I'm not always available for the podcast, I'm more than happy to kind of, answer as many questions as often as possible or put them together and knock them down, on a regular basis with you guys. But, there's no secrets, and if I know the answer, I'll give it to you. And if I don't know the anscer, I'll make something up. So
I feel like you're going to know the answer. Like I sat in on I was walking the round tables and like we were talking, you were like just a complete expert on insurance. Like you knew more about insurance. I feel like anybody. I was like, if we could just clone this guy and just put him at all of the round tables.
I mean, it's a lot of, I think, it's a good example of kind of the issues facing, water sport operators and tour operators is that, when you don't have people that are quote unquote experts, how do you find the answers? I don't profess to know them all, but I think if I could just tell people the mistakes that I've made and what I've learned from them over the years, it probably helps. So, don't take my word for it, but if I can stop others from making some of the mistakes that I've made over the years, that might be helpful to everybody.
We did about, 15, 16 seconds of warming Chris up what we would talk about today's show topic, but Chris is a pistol, so I feel like he can he's going to make a connection on anything. But my first curveball is this, and we'll lead into the greater topic, but I think a lot of people are concerned we're going to a recession for 2024. There's certainly a lot of market signals pointing that direction. As a general rule, where do you stand on startups in a recession? Do you like them or you dislike it?
Depends on where you are. There's a lot of operators that I met at the Water Sports Forum that are in places like where you guys are based in the Destin area and those types of things. So, my experience in recessions is it kind of it slowly kind of spreads from the center out, meaning the markets, unfortunately, just to be direct, like the markets with more competition, those kind of less barrier to entry markets, the drive to markets like Destin, Panama City, South Florida, Myrtle Beach, Hilton Head, those markets are going to suffer more relative to luxury and lifestyle destinations that are in fly-to markets or that cater to clients, kind of in the higher demographic. So, that's really Red's business model. The moat that we kind of build around ourselves first and foremost is location first. And so, I guess the short answer would be, if you have an opportunity to do a startup in a place that, relative to 2008, relative to, COVID, relative to what you're seeing now is outperforming, it will continue to outperform. So if I had the opportunity to do a startup, for example, in Key West, or a startup, for example, in, Kauai, I would probably be all in on that because those are historically the most resilient markets. If my opportunity was to do a startup in Orange Beach or Destin or Panama City right now, I probably wouldn't do that because my guess is that there's too much competition in those markets. There'll be some pricing wars, and most likely, I think you'd probably be able to buy or kind of maybe merge with your competitors before starting up something from scratch in those kind of more diluted markets, if you would.
Yeah, so I think to Chris's point, if you guys are just following along here, the reason I think Chris likes Hawaii and Key West and those fly-in markets is because your demographic is not going to be affected nearly as much as the middle class drive-in markets who are on a budget coming in for a weekend. They're not spending $10,000 on a vacation. I mean, that would be why, correct? Your economic.
That's right.
market.
Yeah. I mean, ultimately, it's like physics, right? Money is never like created or destroyed. It just transfers from one place to another. And so there's always, frankly, wealthier or rich people that are out there. It's just where they're choosing to go. Right. So, if money comes out of the middle class, it rolls up to the upper class and vice versa, depending on different economic times. So, I hedge my bets in places where it's a little bit harder to get to, a little bit more expensive when you get there, even in markets like the Virgin Islands where there might be less people there. They're still paying a premium rate to be there, so they have more disposable income to spend in the market. So we look at that. It will be generally worse for everybody. It's just those high barrier to entry markets where there's less competition just by default are just they're gonna have less of an impact than the higher. And what generally happens is your competitors in those middle markets or those drive-to markets. That's when you get into price wars, right? You start seeing like in the jet ski market or the boat rental market, this weekend it's X amount of dollars, next weekend it's $10 less, and everybody is in a race to the bottom. There's still a lot of people coming. Really hard to keep rate up because somebody doesn't kind of have the balls to keep their rates up, quite frankly, and then everybody has to follow suit on it, right? And so that becomes this tough market, not just in the water sports industry, in any market, right? Like hotels or airlines. You see if Delta Airlines discounts its flights to Orlando, every other airline is going to do the same thing the next week. But if they keep their rates high, Maui, for example, with all the impact in Hawaii that we're seeing right now, you might think, oh, Maui must be on sale. Well, I just looked this morning because I want to go see our operations in Maui next week, and hotel rates are over $600-800 a night. Even though there's 50% less tourists going to the market, the hotels are trying to hold their rate as much as possible to make sure that the people that are coming are the people that are most likely to spend more money when they're there.
Are you tired of spending countless hours managing your water sport and boat rental reservations manually? Is your current system outdated or doesn't provide the necessary features that your business requires? Hi, I'm Greg Fisher, the CEO of WaveRes, an online reservation software built by operators for operators. With our system, you can offer 24/7 online booking to your customers, allowing them to book and pay for their rentals at their convenience. You can also send SMS notifications to your customers, keeping them updated on their reservation status in any any changes that may occur. Custom options and dynamic pricing enable you to offer tailored packages to your customers, helping you stand out from your competitor. Plus, our system integrates with companies like Werewolf Digital Waivers and TripShock, streamlining your operations and ensuring a seamless booking experience for your customers. Our software is the best choice for water sport and boat tour operators as it is designed to cater specifically to your needs. So why waste any more time on manual reservation management? Try WaveRes today and take your business to the next level. For a limited time, mention this ad and receive a $100 credit when you sign up. Check out waveres.com for more info or to schedule a free demo. Now let's get back to the show.
Oh, well, now I'm scared. Now I'm scared. Thanks, Chris. Great. I was already not optimistic for 2024, but now I'm like, God damn it.
Yeah.
Go drive
we can talk about how to do all those things as well, but you know,
you guys hiring?
You just have to get aggressive. Yeah, you just have to be aggressive, and you have to kind of get into that whole guerrilla marketing mindset and try to be as lean as possible, and you know, just kind of out hustle your competitors. And that to your first point is, you know, would I start up? Is probably no. I would particularly if I had an existing operation, I would just focus on making it as good as possible, kind of weathering the downturn. But we'll see. I mean, I don't know, man. It's tough to say. You know, the economic data is all over the place. I was flying the other day, and I couldn't believe how many people were on the airplanes. I'm in Key West right now for Fantasy Fest, and it's a madhouse down here. So, you know, the sky is certainly not falling. It's just, you know, the wallet, consumer discretionary spend is shrinking in certain areas. And if I were you guys, I would look at leading indicators, right? And what I mean by leading indicators is, what are other things where there's lots of data that I can have access to that would kind of give me an idea of what might happen in the water sports industry. For us, hotel rate, and that data from like star reports in the hotel industry that's broadly available to anybody, is something that, you know, for example, we'll look at the occupancy and sales pacing across our hotel partners in the Virgin Islands, and there's a direct correlation to the occupancy and rate of those hotels to what we expect to happen, you know, in our markets, right? So what are the other leading indicators? Depends on where you are. Restaurant spend, consumer discretionary spend, you know, pay attention to like the earnings calls for things like hotel groups, things like airlines, things like Darden and the larger middle market restaurant, food and beverage outlet operators. And I can just tell you, like, if you are catering to the same customer as, let's just call it like the Hampton Inn or the Chili's, you want to listen to those earnings calls or look at the data of where those customers are also spending money, you know, in your market. So, you know, the hotels, the Hiltons of the world that manage, you know, the Hampton Inns and their select services are going to have a lot of data publicly available. And there's a lot of research out there that could say, hey, what's the hotel market doing here? What's the restaurant market doing nationally? What's the restaurant doing in the Southeast market? Where are we seeing, you know, is family spend up? Is you know, business spend up or down? Those are generally pretty good indicators of what type of customer is going to be in your market at what type of volume relative to, you know, this time last year.
This October is very interesting because we've seen about a single-digit drop in number of bookings, but a 25% drop in revenue. Mm-hmm. And Kevin can speak to this. The issue is that we are getting bookings, but the prices are so damn low compared to what they were last year. I mean, take parasailing, for example. This is the lowest parasailing I've seen in 3 years in Destin. Mm-hmm. Boat rentals are cheaper. Jet ski rentals, everything is so much cheaper. So obviously we're dealing with the competition. You know, it's just everyone's, that's right. And the price is driven to the bottom and is hurting our numbers.
Yeah, I mean, but you got to zoom out, right? Like relative to what? Relative to 2019? Like, you know, I think people got a taste of something in this COVID recovery world over the last 2 to 3 years, particularly in Florida, that, you know, if you wound the clock back to, you know, what were your parasail rates in 14, 15, 16, 17, 18, 19, leading up to that resurgence, we look at our numbers in a couple different ways, relative to, are we up or down relative to the 12 months before COVID? And then we look at kind of the last 12 months and the trends there. So like Key West is a very good example. Key West is probably down 20 or 30% to its peak highs in 21 following the COVID surge, but it's still up, 5 to 15 or 20% relative to the 2018-2019 season. Now, adjusted for inflation and adjusted for wage inflation and operating costs and all that kind of stuff, you can kind of extrapolate that. But from a revenue basis, from a number of passengers and average ticket price, irrespective of what your operating costs are, I think what your frame of reference is a big deal. And I think, anybody, myself included, that assumes that, a good thing is going to keep going is probably mistaken. My guess is that if you zoom out, far enough, it will be kind of up and to the right long term. But if you imagine your sales in any market in the water sports industry like a stock chart, it's going to be choppy, right? It's going to be periods of peaks and troughs. But just like anything else, if you click from the 3 month to the 5 year on your favorite stock, you'll see a trend over a longer period of time. And that's what I would be looking for if I was, investing in a new market or investing or expanding in a market, to say, not what's happened over the last year or two, what's happened over the last 5 or 7 years, what happened in that market in the last real recession that we had in 2008, 2009, 2010, how bad could it get? And then, real simply, the first order, the first rule of small business is don't lose money, right? So we look at that from a downside case standpoint. If I were to buy a business, either personally or within the fund, the first thing that I look at is how far could that business drop before it can't keep the lights on, right? And you need to be prepared for your business, just like COVID or whatever it is. You have to imagine that if your business can't be cut in half and you can't keep the lights on, it's probably not a good business to be in. If you're operating in that upper 20% of revenue and margin, and you can't adjust the costs in your business and flex to the point where, if you had a $2 million business that went to a $1 million business, you need to be able to pay your bills both personally and professionally, even if you have to lay off a lot of your staff and run the desk and tours yourself. What is your risk tolerance, and how far can you fall before you have to come out of pocket would be probably the first or second exercise that I would do.
So I want to pivot and say and ask. So, man, I got like a personal question that I really, because it's something I've always felt like and we don't get to like get it too long of it, and it has nothing to do with what we're talking about, but I always just wanted to know, are those combo trips that you guys do down there, because they're very, very popular in Key West, but they don't seem to be very popular anywhere else. Are those severely underpriced, and are the margins on those dog shit?
That's right. Yeah. I would not do them if I didn't have to do them.
I'm sorry, because I led with that here with that product, and it was just awful, man. Like because I was doing literally
that
everything.
Product. Yeah, no, don't do that. I would not recommend that. And if that product, for example, was bundled at the right price to have the margin, that is our highest volume, lowest margin, highest risk piece of business.
That's what I thought.
And it's really led by the competitors, right? It's a good example of, we have different businesses in different places. Key West is the most competitive market that we operate in at Red, relative to price sensitivity. So, we have competitors. There's basically 3 large operators in Key West, us, Fury, and Sunset. And Fury and I are kind of heads up as far as quality and price goes. You know, it's really just what your preference is. And Sunset has historically been the lower price alternative, right? And, you know, Sunset was built over a number of years, and really the owner of that operation kind of pioneered this combo trip 100 years ago. And it's just grown by osmosis.
I'm gonna send him the
cost and the insurance.
I'm gonna send him this episode.
If I could, I mean, I've had that conversation. If I could wave my magic wand and all of us could start selling those components individually rather than in an all-in-one adventure, that would be better for everybody. So it's the same kind of example that you guys are talking about in Destin, or with when your prices are down. You know, it's a competition thing, and you just have to determine if you want to play with your competitors on price and see if you can eke out the margin on volume, or if you want to just, you know, try to create a unique and different experience. I could tell you we're, you know, trying to innovate on those products right now over the last 12 months, because I think that, you know, those products will very quickly become low or no margin pieces of business, particularly with the cost of insurance and some other issues that are coming up, where we have to break those. We either have to get more money for those products, or we have to break those products up in order for them to be viable long term.
When I tried to run that here, I raised the price probably about 20% than the average, and we didn't have parasail included in that, and it was still a dog comparatively to me renting things out by themselves. But no, I just always have I've never like drilled deep.
I'll tell you what,
one of those guys to ask them
the real question. Key is. The very short answer is bundle and save is not the way to go if you are a water sports operator, but incremental additional sales is a very good idea. Right? So where we go wrong in Key West is we include too many things. Parasailing is a great example, right? So not everybody wants to parasail. So if I had it my way, I would sell that same product for about the same price that we're selling it now, maybe even a little bit less, but I would offer parasailing as an add-on, because parasailing is the most expensive thing to do as far as operating costs go. And it's also the thing that not everybody wants to. If you take 100 people out to a power adventure, you know, maybe 30 or 50 of them might choose to opt into parasailing. A lot of people don't. So whether you're opting into something or out of something, you know, you guys are really good at looking at like damage waivers and trip interruption. I would look at it in the same way as like, yes, maybe you need to bundle something from a kind of a lead-in value to get the initial sale. But once they're spending money with you, trying to get them to, you know, add another 15 minutes on the jet ski, or add a parasail, or add something else, or, you know, buy a hat and a t-shirt, you know, really working on your sales funnel, if you can control them. That's the way that we're looking at it is, okay, you know, what portion of this is kind of the loss leader, and then how can we price those things? And, you know, maybe parasailing might be a $50 add-on, which is cheap, you know, as a standalone activity. But, you know, if you're already out there spending $100 doing the other thing, and I can get you for another $50 to add something on, you know, that's basically makes margin on every ticket, versus assuming that we have to fly everybody that wants to fly. So I think you could do it. I think it is a really good product if it's done the right way. I just wouldn't do this all-inclusive model if I was starting over.
Yeah, I've always wondered if that, so it's always what I believe to be the case, because the top line, it's obviously a monster, but then when I would just look at everybody and everything that was going on, and I would just do math in my head when I was a parasail captain there, and I'm just like, man, the margins have got to be really bad on this. So speaking to this whole point, one of the big things I wanted to ask you, I've always thought that, so I wanted to know. But so
yeah, sure.
So when you're going on the private side, let's say you're like, to hell with what these guys say. We're slapping a startup together, and you know, I'm going to cobble together $100,000 from my friends or family or a silent investor. It always seems that every time someone and just anecdotally that I'm speaking to, so that I got this idea and I'm going to go borrow money from my family's dad or whatever, make them a silent partner. They're putting up all the money. I'm going to offer them 50%. Like, I'm going to give them half the business up front. So, I mean, you structured a lot of deals. So, I mean, speak to that. Where do you start with that? You need the money. The banks aren't giving it because we're in not the best lending environment right now. How do you data that together?
And I want to add to your question about sweat equity. How to sweat equity, because there's always that one guy that has some experience or is a mechanic and is like, okay, he doesn't have any capital. So how do you structure him into the whole conversation?
Yeah. Okay. So two questions. So, first thing I would do is look at return of capital, right? So, you need to look and benchmark what the discount rate is, for somebody to invest in a water sports startup, right? I would probably look at that like a restaurant startup. Yeah, I don't know. A lot of people fail in that scenario. So if I'm an objective investor and somebody comes to me and says, hey, Chris, we want to borrow $1 million for you to invest in a water sports company. If Kevin called me tomorrow, my first question that I would ask myself is, okay, what is the minimum return that I would be willing to accept for my $1 million? Is that 10%? Is it 20% on an annual basis? 30, 50%? I don't know what it is, but everybody's kind of going to answer that question differently. I would generally set up a deal like that based on what kind of these benchmark returns. And rather than giving somebody 50% of the company up front, I would say I would probably structure it in two classes of stock, or I would probably structure something in a combination of common equity and preferred equity, where you as the owner founder has more of the common equity and your investors have some of this preferred equity, and the preferred equity essentially gets a dividend. Particularly, think of preferred as like debt by a different name, securitized by more of the equity of the company, or they have an option to convert their preferred into common at some point in time if they're not seeing the returns that they need. So I would probably break that up rather than let's say, for example, like a really simple example, you need to raise $1 million and you have $100,000 and somebody else is going to put in $90,000 or $900,000. Well, you would call this, and we don't have a lot of time to talk about it today, but just for people to go do their research on what's called a GP-LP setup, a general partner, limited partner setup. Go research it on YouTube. It's used in every basic business in the world. It's like another name for a joint venture. But the general partner is the guy or girl that owns the common equity, is the owner, founder, manager, kind of runs the business day to day. And then the limited partner is typically the money guy, right? The limited partner is investing capital and has limited amounts of oversight in the business, but they have controls on the economics. And so you'd say, okay, well, look, I'm gonna raise $900,000, and let's just say that person who's giving you $900,000 wants to see a 20% return on their money. I might break that up into a portion of common equity and a portion of preferred return. First thing I would do is look at the cost of capital right now, and I would say, hey, look, if I went and got that $900,000 from a bank, I'm going to pay 8 or 10%. So right here, right now, out of the gates, I can offer you that same 10% return on the money in the form of preferred equity in the business. So that first $180,000, think of it like debt service. So that guy has gotten maybe 50% of his returns is done in preferred. So you might say, okay, I owe you $200,000 a year essentially in interest. What I'm going to do is I'm going to do $100,000 of that in preferred stock. So I'm going to pay you a $100,000 a year dividend. And then the rest of it, I'm going to give you in common equity. And the waterfall is the first, I pay my bills, and then from the cash flow of the business, the first dollars go to service debt or preferred, and then the rest go to the common equity distribution. And so that keeps you from having to give too much of your common away. You're behind what's called a pref, or a pref return. And so that might allow you to keep, in that circumstance, you might say, okay, instead of giving 50% of the company away, what I'm going to do is I'm going to give a 10% return plus 25% equity in the business. So those two things combined are equal to the economics roughly of about 50%. But then I would also cap the preferred return to say, how long do I want somebody in my business? If I can buy that preferred down and I pay that guy back his $900,000, well, now he's only got, 10, 20, 30% of common equity in the business, and we're heads up because I've extinguished the debt or the preferred after however many years it is. So what you would want to do, in my opinion, is structure something like a joint venture or a GPLP setup with a portion of it going to essentially a dividend and a portion of it going to common equity. So they have upside after they get paid back. They make 10% along the way, and then their other upside is in common equity. So if you sell the business or whatever, they get to participate in the cash flow or the upside, but they get their $900,000 back. They've made 10% along the way, plus they have a residual 20 or 25% equity stake in an underlying business. And by the way, if you don't pay your preferred returns because you run out of money or the business fails, they can come and take more of the common equity to kind of make themselves whole. Does that make sense kind of from a high level structure standpoint? Okay.
I mean, I don't know. I think most of our guys are probably like, yeah, so like, me and my partner just spit on our hands and shook.
Yeah. Don't do that. Don't do that. I mean, you have to first and foremost, everybody says it, but it really is the truth. I mean, doing business with friends is not generally a very good idea. If you are going to do it, you have to treat each other like your worst enemies in that contracting period of time. And I promise you, going out and spending, $2,000 or $3,000 or $5,000 for a reasonable attorney on the internet to give you an operating agreement and that makes sense for both of you as well as your investors is money well spent. Every handshake deal that I've ever seen falls apart at some point. It's just the way that it is. And that's not because you go into those deals thinking that it's going to not work out, but people's motivation changes over time. Their search situation changes over time. And I would encourage you not to do that. But like I said, just doing like a heads up deal, treat your equity investors as debt plus equity, not just all equity, in my opinion, because the equity of a successful business will be worth more, and the risk for you as the founder is kind of like, all right, well, it failed. Worst case scenario, I give 100% of a failing business back to my partner, but he knew that going into it as a financial investor. Money investors are interested in money, not owning or operating water sports companies. So I would encourage you that way. On an operating basis, that doesn't mean that you don't have partners in the GP, right? It doesn't mean that you and Kevin aren't partners in the GP side, the general partnership, the OpCo that's running the business. It just means that you're bringing in a debt or equity partner in addition to you guys. And you might be 50-50 on the residual equity. It might be set up where it's 20% to your partner, 40% to you, 40% to you. And you guys are heads up in the operating agreement of the general partner, and you just got to think about what that looks like with buy-sell agreements and put calls and drag-along and tag-along rights if you ever wanted to get out of the business. And we could talk about that another time. But any competent business attorney is going to be familiar with those types of structures. It's not unique to the water sports business. A lot of the first mistakes that people make is think that the water sports business is some sort of unique beast. It's not. It's the same as any business, right? There, you just have to look at what the risk is and the opportunity. But if you try to make your business more unique, people will shy away from that, because with uniqueness, sometimes there's risk perceived, and I would encourage everybody to not think that way. As far as sweat equity goes, I think sweat equity is a great way to incentivize long-term retention of employees. I would probably do that with a different class of stock or membership interest, which is vested over a period of time based on tenure and performance. Long-term profit interests is a way to do that, or different classes of stock that have different restrictions on them. You as the grantor of that could revoke it under certain circumstances, or vested under certain circumstances. I would probably not just grant sweat equity heads up that is the same class of share as you as the owner founder with all the risk that you're taking. But I love the idea of employee ownership. I love the idea of sweat equity, and I love the idea of them earning more of it over time.
So in a situation where you were to give an employee a piece of sweat equity, in very simplest terms, how would you explain that to said employee who has no idea the difference between common or preferred stock? You say, look, I'm going to give you 5% equity. What in real dollars for them is that a piece of net profit? Like, what does that look like when you're offering that?
Yeah, as it vests. So think of it like buying stock or being given stock in any company, right? Think of it like if I were to give you a share of stock of Pepsi or something like that. So it would be restricted. So in the simplest terms, I would say, like, let's say, for example, I would say, hey, Kevin, over the next 5 years, I'm going to grant you 5% per year in the company, but you have to make it all 5 years, right? If you quit after 4 years, I get everything back. But every year you earn X percent of the business until you have vested all of it. And then once you've vested all of it, your stock is essentially the same as mine, unless I fire you for cause because you steal something or whatever it is. And so when I distribute money in the future, if I took $100 out and you had $5 of it after year one, or 5% of it after year one, you'd get $5. If I sold the business after year one for $1 million, you'd get 5% of that. But it's tied to longevity and performance, and you can vest those shares however you want. It's also advantageous from a tax perspective from the sweat equity partner, because if I give you 25% of a company that's worth $1 million tomorrow, you got a $250,000 tax bill the day that I give you that stock, right? So spreading that out over a number of years, doing something called a 83B election. Google it. It allows you to pay taxes on the value of the stock when you get it, not on the stock in the future of any company, whether it's private or public. And so it's more like stock options, if you would, when people go and work for, the General Motors of the world, or any CEO that's working, for Microsoft or Jeff Bezos or whatever it is, they get stock options. And in your particular case, you would be granting them that stock for basically $1 a share over a period of time based on them doing successful things. But once they have it, it belongs to them. It belongs to their heirs, unless you take it away for some, really meaningful reason that you guys could negotiate what those circumstances would be.
Would this stock be on the books? Yeah. All right.
Yep. So it's just like anything else. It's a contingent consideration. So your CPA can tell you how to account for that on your balance sheet as far as your capital account goes. And then you would have a stock award or restriction grant that's given from you to the associate that says, this year you've earned this many shares of this company. And when that happens, there's a journal entry made in your balance sheet that identifies that and what consideration was given for it.
Got it. Okay.
Well, guys, speaking of all this, I have a meeting with our banker on the investment side here in the next few minutes. But Chris, I don't know that I asked you on the first episode, but if you had one great book on business that you would recommend to our listenership, which one would it be?
Oh man,
I know you're a reader.
That's a tough question. Yeah. Let me get back to you on that, because there's a few of them. I'll send you guys a list of a couple books that I think would be great resources for your team members. Not all of them are long and arduous. There's probably 5 or 6 of them that are kind of required reading in my world. And I'd be more than happy to follow up. We'll publish that to the group.
Awesome, man. Well, hey, man, as always, wealth of knowledge, man. When my head was down, just so you're clear, like I wasn't texting. I was putting in notes, man. I'm like trying to keep up with you. I'm like, shit, I got to look this up.
Sure.
I got to look this up. I got to look that up. And I hope our listeners do the same. Chris, once again, man, thank you so much for coming out. Thank you guys for doing the event. And I'm sure we'll talk here in the future, because I'm gonna follow up with you on that list of books, man. So
yeah, no worries. We'll get it to you.
Awesome, guys. Thanks for tuning in. As always, Keep it awkward.